Good morning, ladies and gentlemen, and how do you do? I'm your host, Seth Julian, welcoming you to today's morning briefing. And unfortunately, we have to continue being Dr. Doom. Things are looking gloomy in Europe, and there is obvious reason for this. France is on strike. France is striking the high cost of living. The refinery workers have been in strike for 10 days already. Tomorrow, the transport workers and the civil servants are going out and striking. The French are very militant when it comes to labor action and political action in the where it affects their pocketbooks. And so, and remember, winter hasn't really kicked in yet. There is no unified energy policy in Europe. These, of course, are the pictures of the stock market indices, except for this is the dollar index, which is, I'll get to this in a moment, but all, except for the cockairon, which is typically contrary, because this is we'll go to the daily on the cockairon. It's kind of doodling up here, but it's still well below the 50 and the 200-day moving average. It's just kissing the 20-day moving average. But the volume is high, although slightly high. And that is to say, where it's gone up here, the decline has dropped. We're expecting to see, as it starts to decline further, increased volume. That's speculation. And let me say, of course, as I always say, ladies and gentlemen, we are talking the capital markets here. This is speculative discussion, and therefore we could be wrong. And therefore you could lose money. You should not be speculating with money you cannot afford to lose. This is not investment money. This is speculative money. That is to say, we try to take a little money on the market in a fairly short time. But so are all our competitors. So there's risk involved here, ladies and gentlemen. And risk, of course, is the possibility of the unexpected occurring. And occur it does. So make no mistake. Having said that, this is what's going to decline. France is starting to get aggravated at the cost of living, and they're striking widely. There is no unified European energy policy yet, and that's a problem because as the winter sets in, there's going to be hoarding. The fabric of the EU is going to start to tear in its underlining, and we believe, again, speculation, we could be wrong, this is going to start to break down support for Ukraine. And this, by the way, we think is essentially the essence of the Putin EU strategy. To break down the EU, to weaken it, to disunify it, and to weaken support for Ukraine. By the way, I just hasten to mention, if this isn't gloomy enough, today starts Operation Steadfast Moon, the annual NATO nuclear drill, which was put off by the outbreak of the war in February. So they're now doing that. This is a nuclear drill. That is to say, they operate with nuclear-capable delivery vehicles like planes and cannon and what have you, but they don't have actually nuclear warheads on them. And the Russians will start their version of that called Grom, I believe, next month. So things are getting pretty tense and serious. I also want to show you this chart because this explains most of what's happening. This is the dollar index. As you can see, it's gotten stronger and stronger and stronger. And the U.S. inflation rate is 8%, and the U.S. interest rate is 3.25% and rising. That's a big gap. And in order to bring down this inflation, this gap is going to have to narrow. In other words, inflation, if inflation stays steady at, say, 7-8%, 0.25% is not going to discourage any corporation from raising its prices. And make no mistake, what's raising prices is greed. Yes, there is some price built into supply line glitches and knots, but this is an opportunity for corporations to really raise prices. And they don't raise prices by 8.2%. They raise them 20%. And this is an opportunity, and in order to discourage them significantly enough for them to stop doing this, this interest rate has to go way more than 2.5%, therefore driving the dollar rate up. As interest rate rises, cash from lower interest rate currencies to higher interest rate currencies, and therefore the demand for the dollar goes up, and therefore its value goes up. I do just want to show the European equivalent. 10% inflation. This is the euro-dollar rate. As you can see, the euro is weakening terribly against the dollar. And 10% inflation, 1.25% interest. Think this is going to change anytime soon? We don't. This gap is what's largely explaining this weakness in euro, as among many other countries, but the euro in particular is under great stress because of the situation I opened up our briefing with, the effects of the NATO Russo war, particularly on the population of France, which is right now standing up on its hind legs and howling. And that's just the beginning. When the winter sets in, people start to get really cold. You're going to see real protests. And we think that we think that everything we've been talking last, I don't know, 6 months, 4 weeks, however you want to, these indices are likely to continue going down, except this one, of course. All of the stock indices are declining as interest rates rise, inflation rises, corporate profits fall, corporate revenues fall because people stop buying. They hunker down. So this is a trend that we see as being well entrained, unlikely to change in the near term. Euro dollar down, the euro dollar is strong, and that's how we see things, ladies and gentlemen. So what we mean, ladies and gentlemen, of course, is to sell and sell short. Sell euro dollar, buy the dollar index, and sell the indices. Sell and sell short, that's how we see it, ladies and gentlemen. Bye-bye for now.